Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, the S&P and the GOOGs putting in a decent green day. Nothing crazy, but it's a start. And no, it was not a question of a highly concentrated green day in which big tech and AI did all of the heavy lifting. We actually had some decent market breadth. It wasn't anything to scream home about, but it was a very decent day, especially after about a week and a half of very low market breadth and high market concentration. Now, the gains today were partly due because of the favorable jobs report that came in early this morning. There was a lot of apprehension surrounding this jobs report because, as you know, we didn't get the non-farm payrolls last month, and questionably, we may not get it either on the Friday session. So all the focus is going to be on the ADP from today. 42,000 net new jobs added to the private side of the economy, in contrast to the expectations of only 25,000. Now, this was probably going to be your biggest earnings, or rather news release of the week. And lucky for us, it came in quite good, which does alleviate some of the pressures that the markets have been facing from the whole jobs market narrative, the jobs market weakening, et cetera, et cetera. So these aren't the largest gains that we've seen, of course, in recent memory, but at least the gains are still positive to the jobs market, and the markets did actually enjoy that. There was a bit of a problem, though. The markets did a good job of using that news to carry themselves higher all throughout the day, but then in Power Hour, which is known as the hour in which institutions participate the most, look at this drop in the last hour of trade. And it gave you pretty much a view as to how institutions are feeling about their positioning into the end of the day with all of these breadth concerns going around right now. Not a very good end to the day, of course, and we are still in the context of daily consolidation on the SPY and on the Qs as well. Now, in terms of other news that we saw today, this one right here, guys, the government shutdown is now the longest that we've seen since 1976. And the reason that it matters for the market, of course, is because of the infamous data dump that could come when the government shutdown ends. We haven't gotten the non-farm payrolls reports. We haven't got a whole batch of other government reports that we actually need to determine whether or not the economy is in good standing right now. So I guess we'll kind of have to wait a little bit longer, but this is definitely notable to us. The biggest concern, as I said, would be the data that comes in after the government ends the shutdown. Moving on further here, guys, we got some comments from NVIDIA CEO Jensen Huang telling the Financial Times that China is likely to win the AI race because its companies have cheaper power and fewer regulatory hurdles. Yes, after all the money that's been deployed, all the billions and, dare I say, almost trillions of dollars deployed into US AI infrastructure, apparently it's not enough. He said the US and the UK are slowing themselves down with what he called cynicism around AI and a patchwork of new state rules. Huang pointed out that China is actively subsidizing data center energy costs, saying for companies, their power is free. So as we well know, a big component of the AI trade, guys, is the power requirements. If you just do a quick little AI search, you use Grok, Gemini, or ChatGPT, it'll tell you that the US does not have the power capacity to serve all of the data center buildouts that will possibly happen by 2030. So there needs to be some heavy investments into infrastructure, and we will have to see whether or not the Trump administration is willing to come out of their pocket and help subsidize that whole industry. In the markets right now, we still remain in a bit of a fearful environment, which is pretty funny because, of course, the markets are very close to the all-time highs. But we've explained this in the past few videos. I did a massive video on Saturday, guys. I highly recommend you go back and watch it the first 30 minutes. We did a bunch of statistical analysis to explain why are people feeling so bad even though the markets are at all-time highs, and what are the concerns right now surrounding market breadth, and also how can we tie that into the general perspective of the narrative, identify, or the perspective of the market, identify the various bearish narratives currently at play, and contrast them to the bullish tailwind. So I highly suggest that you go back and watch that Saturday video because it takes me a long time to recap that stuff in every single daily recap, right? So we won't be doing it today, but just something to continue to be mindful of. And of course, that ties into weak investor sentiment. We raised this concern yesterday to where year to date, guys, people are feeling net more bearish than they are bullish in terms of their forward market perspective. You'll see here that in terms of bulls versus bears, AAII sentiment, the dispersion here is minus 11.1%. Now, usually you get such weak investor confidence or investor sentiment when the market's already down. We've only had those numbers before in 2008 and also in 2022, when we were literally in the deep end of a big old bear market. Now, the S&P is up roughly 16% year to date, but people are still feeling very bearish. So you can see that there's a clear disparity between how the markets are performing right now and how people feel about the markets and the economy, which is why it's such a story-driven market right now. Now, in terms of today's video, guys, we have a whole bunch of things to take care of. Number one, we will be doing 4 different corporate earnings for you guys today: Robinhood, McDonald's, Elf Beauty, and also one that's not on this list, DuoLingo. Now, we're going to cover a few of those because they had massive moves in the after hours, such as DuoLingo and Elf Beauty down roughly 20% apiece. And then we'll be covering McDonald's for their insights into consumer spending, which is very important, guys, because we know consumer spending has been a hot, a hot point of interest for the markets, at least over the last year and a half, 2 years, as consumers continue to struggle with higher prices, inflation, and what they perceive to be as low real wage growth. And then we'll cover Robinhood, of course, because it's one of the fan favorites, so we got to do that one too. Shout out to all the other interesting companies that reported earnings today. There was so much, guys. We could have covered AppLovin, which is a very strong company. We could have covered Dutch Bros, Qualcomm, ARM, Figma even. Maybe if we have some time tomorrow and Friday, we'll be able to catch up on a few of those companies. But for today, Robinhood, McDonald's, Elf Beauty, and DuoLingo. Thereafter, once we're done their earnings recaps, we're going to take a look at our technical analysis on the indexes. Check on the rotation after today was a broad market day. Check on the rotation. How are the various segments of the market doing? Are they doing better than last week? Are they doing worse? We'll check on that. After we're done that, we will take a look at our big tech list as well and derive which of these names can possibly be interesting for some swing trades or maybe even some long-term positions, because some of these names in this list have come down a little bit over the past week, week and a half, 2 weeks of trading, and some of them are indeed positioned quite well, especially for some longer-term portfolio buys. After we are done the big tech list, we will have some time. I'll spend about 10 minutes on the biggest gainers and losers of the day, of which, as always, there were a lot. So we'll take a look at some of the names to the downside here, derive which ones, in my opinion, are possibly some of the best opportunities in the market right now, and then do the same thing for the names that are positive and running very hot today, and also see if we can pick out some swing trade opportunities there too. And that's going to be it for today's video, guys. So it should be a very fun one. Let's get right into it. So as I said, the SPY up 0.35, the Qs up 0.65, and the heat map was not all that bad today. You can't say that it was 100% participation in terms of names advancing, but less bad than we've had over the past week and a half. Big tech, fairly mixed. NVIDIA coming down, but apparently the entire rest of the semiconductor niche moving higher. Microsoft down, and the rest of big tech kind of just participating as well. Shout out to Tesla and Google doing their best to kind of carry that trade further. Financials, not too bad of a day, right? No crazy outperformers, but at least this segment was a bit more broad than we've seen in the past week of trade. Healthcare still remains a very mixed bag. Eli Lilly continues to carry this entire sector on their shoulders, and that's been the case for the past 2 weeks. Consumer defensives, a little bit soft, right? And then industrials in the bottom half of the market, very mixed as well. So you can clearly see, right? It's not the best picture. It's better than the most recent few days, but it's still not a very clear picture whereby we're having broad market rotation back into all sectors. Moving into the one-day relative, this is arguably the only day that we've seen in the past 2 weeks where every single sector of the market is green, which is why I say today was a good day in terms of market breadth. However, in the context of where we stand in the 1 week relative performance, you're going to need a lot more days like this if you want to say that the market breadth is actually back and recovering. 1 week relative, we still stand very mixed. Cyclicals, financials, healthcare, real estate pulling ahead. Everything else led by technology to the downside, unfortunately. And on your 1 month, we've really eroded this chart right here. It used to be that most of all your sectors were green on a monthly performance. Matter of fact, only basic materials and energy, if I recall, were lagging. And now you can see several other sectors have kind of joined Team Red overall. So market breadth is going to be the biggest thing that we need to pay attention to moving forward, because when you have very broad market performance, that's usually when you get the best the best lift overall and the best follow through on a lot of your trades. I'm pretty sure you guys have noticed in the most recent week and a half, a lot of the trades that were working in October, even some of the AI momentum names they're just not following through on their breakouts anymore. The price action is very, very, very choppy. And even on some of the big tech names as well, right? You're just not getting the follow throughs that you were used to back in September and October. So the market's very choppy right now. As I've said, it's a battle of the narratives. And until we get one of two things, in my opinion, until you actually get a big weekly 5 to 7% pullback on the SPY and QQQs, start consolidating on the weekly timeframes, consolidate a little bit on the monthly timeframes, or you bring back broad market participation, it is going to remain a very choppy market. So please keep that in mind. That's it for your introduction, guys. Hopefully you enjoyed. And now let's dive into some company earnings. And we're going to start it off with Robinhood, everybody's favorite. Well, not everybody's, but one of retail's favorite names, let's say the least. So Robinhood coming out with their earnings. And you can see here, the stock is down 2%. Unfortunately, they got the Palantir treatment. Robinhood just put out some of the best numbers that they've ever put out in the company's history, and yet the stock is down 2%. Now, part of that is due to the fact that Robinhood doesn't trade very cheap right now. So you're going to have to show increasing earnings, like better and better earnings for the stock to actually move higher, which, funny enough, they did today, but just were not rewarded for it. So still a bit of reluctance to bid this stock higher while it's been at these high valuations, arguably since the early portion of the month of October. Now, in terms of their earnings, guys, they smashed it. Beat on EPS by 13.36. They beat on revenue by 5%. And the guidance was also very strong. They absolutely smashed every single metric. Let me show you. So Robinhood posting insane numbers, revenue up 100% year over year. That number was absolutely staggering. People were happy last quarter when they posted 45% revenue gains year over year. This quarter, 100% in terms of revenue increase. Very solid. Platform assets increased by 119% overall year to year to $333 billion on the platform. Average revenue per user also upticked 82% year over year to 191. You can see that last quarter, it was at 151. So huge increase by Robinhood across all metrics, and adjusted EBITDA, 177%. And adjusted EBITDA margins, guys, they're getting better. As they continue to scale revenue, the company is becoming more and more profitable. In terms of your net margins this quarter, 43.7% net income margins. Q2 was 39 and Q1 was 36.2. This is huge stuff for Robinhood, guys. You might remember not too long ago, a few years ago, Robinhood was actually unprofitable, and they very quickly, since 2024, turned into an exceptionally profitable company, now recording 43.7% net margins overall. A few more numbers for you guys. Transaction-based revenues was up 129%. That beat the estimate. Crypto, 268 million. That missed the mark by 287. But this is largely the only thing in the entire report, that was actually bad. Still, though, even though they missed the estimates, that volume was up 300% year over year. The options right now, they beat the mark on that one too, 304 million. That was up 50% year over year. Equities, right? In terms of the revenues they make from equities, up 132% year over year. Net interest revenue from their margin accounts beat the estimate, up 66% per year. And other revenue as well, largely beating the estimate here by a huge margin, up 100% year over year. These numbers, guys, are absolutely insane for this company. But like I said, they got the Palantir treatment. Possibly a lot of this was baked into the share price coming into these earnings. Customers and platform. Now, the reason I'm going to go through this Twitter post right here is because sadly, Robinhood did not release their earnings presentation for me. Usually, I love taking you through Robinhood's earnings presentations because they do a really good job. This was last quarter, so they put everything in very beautiful slides. They show you the the quarter over quarter and year over year gains. Sadly, guys, I've been waiting for these for like 3 hours, and they're not out yet. So I guess we'll have to do with the Twitter stuff right now, right? So in terms of funded customers, guys, 26.8 million, as we said, 10% year over year. Investment accounts up 11% year over year to almost 28 million investment accounts. Total platform assets we talked about. Net deposits, 20.4 billion over the course of the quarter. Trailing 12 months, 68 billion. That was up 45% versus the same quarter last year. Robinhood Gold subscribers, their premium subscribers, 3.9 million. That was up 77% year over year. These numbers are insane, right? I mean, I guess we could kind of reference some of them with their Q2 presentation in terms of the Gold subscribers. Give me a sec. So their gold subscribers last quarter, right? 3.48, now well above that. Look at these growth rates from where they started just a few years ago, just to put it into context, right? So all these numbers that I'm talking about today, expect them to be largely above the charts that we previously had. It's unfortunate I don't have the slides, but we'll just have to make do, right? And the average revenue per user, of course, we talked about it, 191, up 82% year over year. Fantastic numbers. We already talked about the margins. Net income, 556 million, which was up 271% year over year. Absolutely insane, guys, right? We can talk about this all we want, but they blew every single metric completely out of the water today. Very, very strong. And additionally, we have some preliminary October highlights, which we did talk about on the earnings call as well. Record monthly trading across equities, options, prediction markets, and futures. So they're carrying last quarter's momentum into the month of August as well. Extremely, extremely strong. Some comments by Vlad. Relentless product velocity drove record business results in Q3, and we're not slowing down. Q4 is off to a strong start with record monthly trading volumes and new highs for margin balances. A little bit worrying that they're focusing on new highs for margin balances, but it is what it is. Some additional highlights from the company that we took from the earnings call is that the new additions to the platform now at this stage will be short selling. That's not live just yet, but will be coming live in about a month. It's crazy to think, and Vlad talked about this as well on the call, that they've been able to make all of this progress in terms of the numbers without short selling. So now they're trying to appeal to a more institutional demographic to use Robinhood's platform. They're also going to implement social trading. This is what some other companies have done, to where you can see other people's trades, other people's portfolios, and kind of either be inspired from them or kind of just make it into a more it's not quite social media, but just have perspective into what other people are doing. Not many brokerages do this, so it's nice to see them integrate that. They're also making a lot of progress on their Bitstamp integration. This is a standalone crypto platform, which has been getting good volumes for them. And the big one, which is what a lot of the retail community always talks about, is they want to start their journey into the banking segment. Robinhood is a standalone brokerage. Now, a lot of the times, especially for high net worth individuals, right? When high net worth individuals have a bunch of loans or mortgages or high checking or savings account balances, right? Traditionally, that type of client will stay within the bank's ecosystem and use the bank's brokerages themselves, right? However, what Robinhood is trying to do is they're trying to expand into banking, to expand and attract not only the high net worth individuals, but also a lot of people in the middle class that want to have all of their assets under one same roof. So banking is going to be the big potential for them moving into the next few years. Additionally, their international expansion. Now, Robinhood hasn't expanded much internationally. They're starting into Europe. They're trying to get into Canada as well with more than their current crypto offerings. So keep an eye out for that. Banking and international expansion are going to be the two biggest growth drivers for the company, in my opinion, over the next few years. Now, that being said, as well, they're doing really good here, guys. I highlighted it. Incentives and matching for transfers. So they're really trying to attract people from other brokerages by offering very large incentives. And when they don't have the best incentives, they will do price matching from other corporations' incentives as well. So everything for this company, guys, in terms of trading volumes, in terms of net new customers, in terms of gold subscribers, in terms of net interest margins, right? All of that stuff is doing extremely well for the company. But as we said, it's the Palantir effect, right? The companies ran a tremendous amount over the course of the past quarter into these highs from last earnings, roughly back here, yeah, from these lows to the top. That's 59% in a single quarter. So it raises the question, like, how much more can you possibly expect? How much of this is actually baked into the current share price? Talking about the current share price, is Robinhood a good deal up here with the revisions to their growth into 2026 and beyond? Let's have a look. 2026 forward PE ratio at 140 is about a 65.1. Not terrible for a fast-growing company, but they are only growing EPS at 22.5% per year. And I say only, it's a fantastic number on its own, right? But the problem is when the P is very high and your EPS isn't in the 30s, you get a PEG ratio of 2.89. Now, that is better than what we had earlier this year when the stock was trading there and we didn't have end-of-year guidance and we didn't have 2026 possible estimates as well, right? So it is better. It's nice that they're executing and that it wasn't a fluke this year and that they're really performing really good across all metrics. Equity, options, futures, prediction markets is going to be a big growth driver for them as well, right? So 2.89 PEG, not terrible, right? Like something really bad would be like a 4, 5, 6. That's when you know you're really paying too much for a business. Price to sales though, guys, it's 24, right? So the company's only making about $5.5 billion next year, and they are trading right now at a market cap of $126 billion. So Robinhood is kind of in that camp of it's a great story right now. They have a lot of growth drivers ahead of them, but is the stock currently priced in too much? Well, the answer is yes and no, and it depends on your time horizon, right? People investing in Robinhood right here at 140, expecting the stock to double in maybe like 3 months as it has in quarters prior, well, you're probably overestimating what the stock can actually do. It's the law of large numbers, right? The market cap is currently working against them. However, if you are invested already in this company from a lower price or thinking of investing in this company for the big growth drivers that are ahead of them, and you want to stay in this position for the next 5, 10 years and see what they can do, I think there is a very real capacity for the company to 2x the market cap from here into the $200, $250 billion range. They have great competitive advantages. People love their products. They resonate really well with the younger demographic as well. And their expansion into banking to attract some of those more legacy clients that have a lot of assets in traditional banks could be very fruitful, as well as their international expansion as well. So the runway for the company's growth is very long and very broad as well, since they're doing a whole host of different things right now. So if we have a long-term time horizon, we can justify buying at these multiples. Is the stock cheap though? The answer is no. You have to realize that you are paying a bit of a premium for that growth, even as a long-term investor. Hopefully that all makes sense. That's everything I had for you for Robinhood. Now, let me just refresh this, man. It's really bugging me. Can he release the slides or what? No, still no slides. So I guess you guys will have to look at those on your own, but we pretty much recapped all the numbers. So none of those things in the slides should be a surprise to you. Stock number 2 that we're going to be covering is Elf Beauty. Elf Beauty coming out with their earnings down 22%. Now, Elf Beauty, guys, is a mix of two things. Number one, they do really have an amazing suite of products, and they really have good marketing, right? So their products are really catered to a younger audience or a more budget-conscious audience. A lot of their products are, the price ranges of their products is between about $7 and $12, which is about 50 to 100% low than the industry standard competing products from Estee Lauder or other higher-end niches as well. So they do resonate very well with a younger demographic or a more budget-conscious demographic, which has led to incredible growth rates over the past few years. But of course, earlier this year, there were some concerns surrounding the tariffs because they source a lot of their products from China. And of course, there's been the perpetual concerns about a consumer slowdown. Now, the consumer slowdown arguably doesn't affect their brand as much as it would others because they're kind of the go-to brand, right? When times get a little bit tough, when budgets get a little bit stretched, well, usually people will trade down from $20 mascara products down to $7 to $10 mascara products if the quality is relatively the same. And that has been Elf's business proposition this entire time. So the fact that they're down 21.5% right now might lead you to believe that there's something wrong inherently with this company. No, that's not the case. But what they did have to say about tariffs and other things of that nature, which we'll describe currently, right? Those are some of the reasons for the declines. So let's jump right into it. So you'll see the earnings here beat by about 20%. That was very strong, but they missed on revenue estimates by about 6%. The company did raise prices earlier in August by about $1 on every single product to kind of mitigate the impact of tariffs, but tariffs have been holding them back a little bit. Let's take a look at some of the numbers. So the easy numbers for Elf Beauty. Revenue was up 14% year over year, a slowdown from the explosive high double-digit and triple-digit gains that we were seeing post-pandemic, but still 14% year over year in a tough cosmetics landscape is very good. And I'll show you the slides later, guys, but just to show you, right? They're doing a lot better than people in their category. Mass cosmetics and skincare overall, in terms of consumption trends, only went up by 2%. Elf was up by 7%. So they're making the most of a tough consumer landscape right now, which is what I like to see as an Elf shareholder myself. That being said, adjusted EPS was actually down 12% year over year, as they do struggle with margins as a result of tariffs a little bit. Gross margins also taking a 2% hit year over year because of tariffs, of course. Moving into more numbers for e.l.f. Beauty, you'll see here that although revenue was strong, as we described earlier, it did miss the mark. In terms of their fiscal year 2026, which is, by the way, if they don't run a normal calendar year, you can see here they're in Q2 of 2026 already. So for the end of the next 2 quarters, this is their guidance. Sadly, coming in underwhelming, 1.55 versus 1.57. This is what Wall Street didn't like to hear. The estimate was for 1.65. Adjusted EPS, also the guide lower. Impact of tariffs on margins hasn't been easy for the company overall. 2.8 versus 2.85. The estimate from Wall Street, 3.53. So when you miss on revenue for this quarter, and you also miss on revenue for the full fiscal year end in the next 2 quarters, and you miss on EPS as well, it's just not very good. And they also missed on EBITDA too, down a little bit. Impact of tariffs, of course, but as well, it's a very difficult landscape for cosmetics right now. But e.l.f. is arguably the best performer out of the cosmetics landscape. So there is a silver lining in all of this. Now, other metrics, net sales growth, 27 quarters in a row, which is very good. We talked about the gross margin decline here, 1.65% year over year. That is because of the tariff impact, of course. And their ARPU, average revenue per user, actually saw growth, which was aided by a different mix of pricing and products overall. Not too bad, guys. We gained 140 basis points of market share, which is a fancy way of saying 1.4%. While other people were losing market share and had slower revenue growth profiles, e.l.f. gained and was the best performing company in the cosmetics segment. And they saw a record launch of Rhode, the brand by Hailey Bieber, in Sephora, North America. We remain focused on share gains and the white space ahead, said the CEO. A few more comments by the CEO from this article right here. You'll see e.l.f. Beauty plunged 29%. Now they're down 20, but initially they were down 30 on weak guidance and the tariff impact, of course. Hailey Bieber's cosmetics line Rhode is expected to increase e.l.f.'s annual sales by $200 million in this fiscal year. Rhode, which the company acquired earlier this year in a blockbuster billion-dollar deal, is expected to increase its annual sales by $200 million this year, and thereafter $300 million on an annual run rate basis. Very strong acquisition for the company. When they did this deal, there was a few people saying, I'm not too sure if it's going to be accretive to the business. Well, the numbers kind of speak for themselves, right? Rhode's expected contributions to sales represents about 13% of its revenue forecast, highlighting just how important the deal is to e.l.f.'s future as its outsized growth continues to moderate. Moving on a little bit further, the CEO blamed the misses on revenue and guidance on the fact that the company didn't release guidance last quarter, which he said can impact consensus estimates. This is true, but, at the same time, you kind of have to give a better explanation than that. It's not only because of that. You can admit that the consumer landscape right now is not the easiest, let's be honest. We actually believe both the sales that we delivered as well as the guidance on net sales are quite strong. And he's not wrong, but once again, the context matters a lot. They are good in the context of a very tough consumer landscape and a very tough cosmetics segment. They are good, though. e.l.f., which primarily sources its makeup from China, has seen its profitability crushed by President Trump's new tariffs. During the quarter, its net income fell by a staggering 84%, while the company said gross margin fell by 1.65 percentage points. Net margins, guys, not the best highlight for the company in this quarter. Only 1% net margins. You can thank tariffs for that. Last quarter, they had 9.4% net margins, and in Q1, 8.4%. They did say that tariffs were going to negatively affect their net margins, but the $1 increase on their products that they did back in August is still not fully realized across the different products right now in terms of the numbers. So, Amin said, the CEO said the second quarter is expected to see the greatest hit from tariffs, meaning this quarter right now is supposed to be the one that has the biggest net impact from tariffs, and the impact is expected to moderate sequentially from there. Now, that is also in part due to the price increase that they did in August. In response to tariffs, we took our prices up 1%. That was effective August the 1st. So you're seeing the tariff impact without pricing in this quarter. In the second half of the year, gross margin will actually improve sequentially. So at least there's that. Rhode is e.l.f.'s primary growth driver for now. It launched in Sephora in stores nationwide in the US in September and was the biggest brand launch the retailer has seen in North America in its history. And that's saying something, man, because Sephora has seen some pretty big launches in the past. It was 2.5 times bigger than the number 2 second biggest launch ever, so it's performed extremely well. We continue to see incredible potential for growth, not only in North America, where we just launched, and the UK, where we're about to launch, but also internationally. We definitely see global potential for that brand and see it being much bigger than it is today. This is true. e.l.f. Beauty is continuing to expand internationally in the UK and several other end markets as well, so the growth runway for e.l.f. is still very much on the table. If we take a look at a few earnings slides right here, we'll notice the consumption trends. It was very hard for the rest of the beauty and mass skincare market, but e.l.f. Beauty actually being the best performer of the bunch. In terms of their dollar share, lipstick, that was up, man. I mean, e.l.f. Beauty continues to gain market share every single quarter. This company would be a problem if they were hemorrhaging market share or if their growth in terms of market share had peaked, but that's not the case. They're gaining lips, eyes, and face, which is kind of what e.l.f. stands for. e.l.f. Beauty is an acronym for eyes, lips, and face, which is why you see these emojis. Anyway, sorry about that. Moving forward, 27 consecutive quarters of market share gains. Not too bad at all. So looking forward to seeing if they can deliver more. One of one cosmetic brands out of 988 to gain market share for 27 consecutive quarters. Like I was saying, man, it's been a tough landscape for the past year. More than that, the past year and a half, 2 years for a lot of cosmetics brands. But e.l.f. is one of the only ones that continues to gain share and continues to deliver double-digit growth in terms of revenue. Now, that being said, their growth is indeed slowing down, and we have to recognize that. And I was saying that 2 years ago when I first covered this company on the first time for the channel, when they used to have 40, 50, 60% revenue growth rates. It's slowing down. 2028 revenue growth profile was 28%. Now it'll be a very nice 18 to 20%, which is much better than the rest of the industry, of course. In terms of net sales growth, you can see that right here. There's your 18 and 20, and high growth consumer, 13% as well. Global beauty. Look at the outlook for global beauty, man. Household and personal care, 0, and global beauty down 1%. So they are the best performing stock in the bunch, or not the best performing stock, but the best performing company in the bunch. Arguably the best performing stock as well in terms of their gains from when everybody got crushed during the tariff segment. Now, I'm not going to go through this entire presentation, but we are going to show you a couple different more slides just to derive, because of course it's a beauty brand. We have to look at some of these social metrics as well. So here we go. In terms of surveys, right? The number one favorite teen cosmetics brand, 36% of respondents saying they do prefer e.l.f. Beauty over competing products such as Rare Beauty, Maybelline, Charlotte Tilbury, and L'Oreal. L'Oreal is the biggest company on the planet. So it does go to show that their marketing campaigns have been resonating very well with the exact target demographic that they want to go after. People, basically millennials, Gen Z, and under. Take a look at more qualitative aspects for the business, which are also very good in terms of their brand awareness. You can see here the gains from 2021 to 2025, 13 to 45%, Canada 8 to 26, and Great Britain from 6 to 19%. So they're really doing a good job of expanding in their end markets overall. And I'll remind you what their brand value proposition is. It's to provide similar quality products to the higher end brands, but at a fraction of the price. You can see here for some primers, theirs is $11 versus $38. In terms of their lip gloss and other end products, $9 versus Prestige $42. Their Halo Glow Skin Tint, which was one of their most popular products this year. Don't ask me how I know, man. I don't use it myself, but you got to follow the social media trends, right? $18 versus $48, and some of their serums $17 versus $185. So although the tariffs have impacted them, and although they have had to increase prices, their price points are still far lower than a lot of companies out there in terms of their competition. So overall though, guys, e.l.f. Beauty is executing well in a tough niche right now. They have been impacted by tariffs, but if we take what the CEO had to say as pretty much, fact, well, the impact will be better moving forward. They will have easier comparable numbers. Gross margins will be ticking up. The Rhode acquisition is doing wonders for their business as well. And I'll remind you guys, e.l.f. Beauty has a very long runway of growth possibly ahead of it as it continues to gain market share as the demographics change, right? As long as they're resonating well with their target audience, which is millennials and under, I do believe that their market share will continue to improve, and just their brand awareness as well as they expand into more international end markets. And keep in mind, guys, it's only a $6.7 billion company. I mean, after a 20% drop, it's now like a $5.5 billion company. But, you know, just to show you guys that it's not that big of a company at all. In terms of their growth moving forward, their growth is still very good, but it's not the 40-30% growth rates that we used to see. But look, EPS growth will be resuming up and to the right through 2027, and revenue continues to be very strong moving into 2027 and 2028 as well. And now I know what you're thinking down here, that now that the stock is back down to around the low $90 range, back into a big area of prior support for this stock that's played out a few times, is it now finally a buy? I was saying, I'm kind of holding off. You might remember I bought a lot of it down here. Am I buying more down here at 90? Probably, guys, because the fundamental thesis for the business is intact, right? If we're a long-term investment, we have to see beyond the short-term tariff trends. We have to focus on, is the company executing its strategy well? The answer is yes. Is the brand still resonating with its end consumers? Yes. These are all different social metrics as well that you have to really pay attention to, especially if you're in anything related to the consumer, whether that's different food companies, right? Whether it's apparel companies, whether they're cosmetics brands, the story matters a lot, and their execution with their target audience matters a whole lot as well. And Elf Beauty is firing on all cylinders in terms of both of those fronts. Now, in terms of the valuation at $92, where they stand in the after hours or right now after those earnings, you're currently trading at a forward price to earnings of only 20.86. That is really, really good. Now, they're growing EPS at 24% per year, which means that now finally again, they're trading under a 1 peg. You might remember down here, I was saying it's a screaming buy because the peg was like a 0.6 or a 0.65, something really low, right? It's now back down under a 1 peg, and price to sales is only 2.75. The company's market cap is $5.5 billion. They are still a profitable business, even in spite of the recent tariff effects, right? And look at these revenues, man. Next year, they'll be generating almost $2 billion in revenue for a $5.5 billion market cap with a long runway of growth as they continue to gain market share. That's not bad, right? So I still remain a longer-term Elf Beauty shareholder, and I would not mind adding any shares down there, playing some short put options, right? And maybe even if we really wanted to. I know it's a tough landscape right now, but in terms of a speculative leap call option through 2027, you can't do it with a short amount of time, right? But longer dated leap call options starting to get interesting again as they kind of were back here. So those are my thoughts on Elf Beauty. Hopefully you guys enjoyed. Now, company number 3, we're going to be taking a look at another one that dropped huge after earnings, man. And it's not been a very easy year for DuoLingo, has it? They started off in, well, they didn't start off, but they went all the way up to about 540 during the month of May. And now after earnings, again, this company is down 22%. Unfortunate for them. They're now trading at $210 per share. So from the top to where we are right now, 62% decline since the month of May. Very unfortunate drop off from DuoLingo. And they're battling a very tough narrative right now, which is the AI narrative. Now, this came into question after last earnings where, they had really strong earnings. And then the day after that, OpenAI released its translation services, which led to several people on social media questioning whether or not DuoLingo was going to still be able to grow as a company amidst the AI narrative. But then, of course, there's two different aspects to that thought process. Number one, it is true that LLMs will be offering real-time translation services, and they have very good products, right? Both audio translation services or text-based translation services. Everybody knows that. But Google's been offering those translation services for years. The other way you can think about it is, are translation services the same as language learning services? But DuoLingo is also branching out into mathematics, into chess, into different areas of study as well, which of course you can learn through ChatGPT too. But this is a learning company, right? It's not a translation services company. So potentially the target demographic of people who need translation services is different from the people who actually want to learn a language proactively to be able to speak it, or for professional reasons, right? If they're looking for a job in another country or things of that nature, yeah? That being said, it's not been a very easy narrative for them to get out of. We know that sometimes these narratives are very powerful. As I always say on the channel, we brought this up during UNH's sell-off. We brought this up during Google when it was battling its own AI narrative, and so many other companies, right? A stock's price is often a reflection of three things: the technicals, the fundamentals, and the good old sentiment. Sentiment is the only one that can make this and this not even matter. A company can go oversold so much. I mean, look at FactSet. FactSet's another prime example of that right now, yeah? FactSet is trading at some of the lowest RSIs the company's ever had in the history of the stock, right? But nothing bad happened at all, but it's the sentiment portion of this business that's struggling, right? Is AI, after they posted somewhat soft earnings, it wasn't a disaster, right? Somewhat soft earnings, it came into question, is AI going to disrupt this very strong data analytics business? And you have so many other examples of AI just crushing other companies in terms of sentiment, right? You remember the UNH sell-off? This was an entirely sentiment-driven sell-off. The company started being cheap here and then there, and it's been cheap this entire time, and yet for a long time, nobody cared. It didn't matter how oversold the company got, people just kept selling more. It didn't matter how fundamentally cheap this company got, people just kept selling more. On the flip side, you have the opposite example of this, which is like a Palantir, right? To where it doesn't matter how overbought the stock is on a monthly time frame or sometimes the lower ones. It doesn't matter how fundamentally expensive this company is because the sentiment is just very strong and the story surrounding the business is very positive. Well, DuoLingo is a company whereby right now you're noticing this again, right? To where our little pie chart comes into play yet again, to where the sentiment aspect surrounding this business is a lot stronger than the fundamental numbers that they post, and arguably even the fact that sometimes they can make their way into oversold conditions and people still sell it regardless, right? So that being said, in terms of the numbers that they posted, the numbers were not bad. There's a few things that they missed on that Wall Street focused on a lot, but 21% to the downside, maybe a bit aggressive in terms of a sell-off, maybe a bit overdone. EPS beat by 684%. This is fake news EPS though. Unfortunately, a lot of this is due to a one-time realization in terms of some tax benefits, which drove net income higher, but also drove a lot of that in terms of earnings per share. If I were to remove the impact of that tax benefit, still, the company posted pretty decent net income margins, guys. Without the tax impact, it's like 25.5% net income, which is better than their most recent few quarters that they've delivered. Now, in terms of their revenue was up 4.4%. Decent beat, nevertheless, therein as well. But don't worry, I'll show you what exactly went wrong with this company. On to their easy numbers. Revenue was up 41% year over year. Strong revenue numbers. Daily active users was up 36% year over year. So until this daily active users slows down meaningfully, you can't really say that AI is killing their business just yet, right? Paid subscribers was up 34% year over year, strong number as well. Adjusted EBITDA was up 67% year over year, and their margins still remain right around 30% for EBITDA margins as well, excuse me. Strong numbers, more numbers for you as well, right? So daily active users, a quick point that even though they had very strong year over year gains, they did miss the estimate here. So that's not red flag, but negative point for the earnings number one. 50.5 they came in at. The estimate was 50.73. But that is one of the only active users metrics that they did miss on overall. Now, in terms of their Q4 outlooks, sales, they didn't beat the mark by that much. The estimate that they gave was for 275 million. The Wall Street estimate was 274. That's not terrible, right? But it just came in line. So there's nothing to celebrate in terms of their guidance. In terms of EBITDA, this was also down a little bit. And I'll explain why this matters. It's not only the Q4 outlook, but it's what management said on the call that kind of rubbed people a little bit in the wrong fashion. Let's move on a little bit further here. Here's what was said that really bothered people, okay? We're prioritizing user growth over monetization in the A/B tests that get launched. And it's more than that, guys. Essentially, what this does is that it leads Wall Street to believe that these margins may not stand up. And also, the company is able to monetize its users may slow down partially into the next few quarters as they kind of pivot a little bit of their business strategy, prioritizing user growth over monetization. So that means that maybe the margins will come under pressure a little bit. And as a result, your amount of paid subscribers may not have these same growth rates by the same time next year. The comments specifically were this: in Q3, we decided to shift the balance towards longer term initiatives. In particular, we're investing proportionally more in teaching better, and we're prioritizing user growth over monetization, which we just said, right? But they're investing more and now focusing less on monetization. You immediately have to think, okay, their margins might come under pressure over the next few quarters. Not under pressure, but it's just that they're gonna, kind of come down a little bit, not go to zero and under, but they're gonna come down from what they currently are. And when you're a fast growing company like this, Wall Street wants to see continuous growth in margins, not slowing down from a business pivot. This shift is reflected in our full year guidance. We're doing this now because we want to keep growing users for a long time and because our increasing conviction that AI can fundamentally change what's possible in how we teach. So a slight business shift in the short term to prioritize user growth and capturing a wider audience. Hopefully that does yield the long-term results that the CEO is talking about right here. Moving on to some of the metrics right here. DuoLingo's soft booking forecast overshadows the revenue beat. Of course, people are talking on social media about the bookings miss, and that was another portion, another kind of a negative point to their earnings. The company forecasts bookings to be between 330 roughly and 335. The midpoint is 332.50, below the estimates of 343. So they missed on bookings as well. That's what the CEO was talking about, saying, listen, what our business pivot we just talked about right there is going to be reflected in end of year guidance. You see it in the bookings, you see it as well on the reduction in terms of net earnings too. So what we're talking about now is we will focus on monetization, but the balance is shifting a little bit. On a relative basis, we're going to work more on teaching quality than we have in the recent past. The company operates on a freemium model and has sought to convert free users to paid subscriptions, such as Super DuoLingo for an ad-free experience and DuoLingo Max, which incorporates generative AI features. We talked about that last quarter when we covered this business. A lot of implementations from gaming in terms of how they try to gamify the experience of learning overall. We're one of the few companies that have found a way to make profit off of AI. This is actually profitable for us. So we had some good comments by the CEO. Obviously, he was talking about in the earnings call, he was talking about the growth of the business recently, but there was a lot of focus on this pivot that they're doing right here, and it kind of rubbed Wall Street the wrong way. As a result, net bookings for next quarter are down. The earnings before interest and taxes are also guided down. So we might be expecting some growth slowdowns in user monetization. Hopefully, it translates to this: more daily active users on the free side of the model as they try to cater to a wider audience. They're implementing new things in terms of chess, new things in terms of mathematics. They want to expand their teaching suites of products over and above their language offerings right now. So what they're trying to do is they're trying to grow the total addressable market of the business, and in the process, they may have to sacrifice in terms of their monetization gains a little bit, and in terms of their margin gains a little bit too, as they invest in those new offerings as well and into new marketing campaigns to attract the customers. That is why DuoLingo is down 20%. But additionally, the black cloud of AI sentiment around the business obviously doesn't help, right? We were already very negative momentum heading into this earnings call, and this doesn't help the business too. So the next question you might ask is, at the low 200s right now, deep into the next support range, which is levels from the highs of 2024 down here, all the way down here, right? 60+% off the all-time highs. Is the company now finally a buy? Because we covered them after earnings when they were all the way up there, and I was saying, company's a little bit expensive for me. Well, now that the share price has got cut in more than half since last earnings, is the company finally a buy? If you are looking to position in this, if you believe in the narrative of the business, right, and you want to go against the prevailing sentiment, well, as a matter of fact, it actually starts to make sense right now. They have very good revenue growth rates for the next few years, 22% per year. EPS growth is 32% year over year for the next few years. Very nice expansion for the business, right? In terms of their EPS, look, smooth, consistent up and to the right. Revenue, consistent up and to the right. So the business is doing well, but it's just the sentiment and the company's recent pivot that kind of leaves a bad taste in some people's mouths. Now, at $205, where they are right now, trending a forward price to earnings of 43. That's not too bad, guys. They're growing EPS on average for the next few years at 32%. Gives them a peg of 1.34. Finally. Because up here, the peg was like 3. So it was tough to make an investment case for the company that it was cheap. But with these growth rates at a 1.34 peg, now it makes sense. The risk-reward profile of taking this bet for the company makes sense. I'm not telling you that you have to do it. I'm just saying if you are interested in this business, the risk-to-reward profile is now favorable. onto price to sales. Price to sales is a 9.3. I will remind you all the way up here, it was closer to like a 16, 18. So now this price to sales metric also makes sense for a company growing 22% year over year. So the moral of the story is, yes, is the company facing current short-term headwinds? Yes. But are they firing on all cylinders? Is AI disrupting their business? Can we see it in the numbers right now? The answer is no, right? So once again, now finally, we have good technicals. This daily time frame tomorrow will be deeply oversold. The weekly time frame will probably be making its way into oversold conditions, or at least the most oversold that the company's ever been in its public history. So we have good technicals now. We have better fundamentals now because the stock price is cheaper, but sentiment is still sour. So if you want to believe in this and this, eventually, long-term, these should prevail. But it's very tough for me to tell you when the shift in sentiment is going to happen. In my opinion, this only happens, the change in sentiment, it takes the company a few quarters to post really strong numbers for people to say, okay, maybe we overreacted. Maybe that narrative isn't actually true. So if you're investing in DuoLingo now, am I expecting to see ridiculous gains here in the next 2-3 quarters? No, but potentially over the next year, 2 years, 3 years, it may be a decent long-term investment in terms of a nice compound annual growth rate if the company keeps executing the way it is today. And that is everything that I had for you for DuoLingo earnings. Hopefully you guys enjoyed. Now let's move on to company number 4. I know it's been a very busy earnings so far. Hopefully you guys have appreciated these earnings rundowns. Let me just move my tabs over and let's get right into it. So we're going to be covering good old McDonald's. McDonald's is very important. Now, some of you might say, why are you doing McDonald's? Why can't we cover some fun stocks, right? McDonald's is a very important gauge of consumer sentiment and consumer spending, guys, right? They have a lot of data into insights in the consumer, and we have to pay attention when companies like this report, companies like Walmart, companies like Costco, right? Because we know that quick service restaurants have been getting killed left, right, and center. Chipotle has been getting decimated this entire year. Kava has been getting decimated. They just had their earnings the other day. Although we did not cover them on the channel, go and look at what the CEO had to say. They said that the same thing as Chipotle basically is that, listen, our consumer demographics are just out of money. They're just not visiting our stores in the same fashion that they were previously. You can look at names like Wendy's. Wendy's is down a ton. Even sit-down brands like Texas Roadhouse, they have not been having an easy year either. So we know that the quick service restaurant landscape has been rough. Even Domino's Pizza, which is a fairly resilient company, they've been through a few of these economic cycles. Even they have not been having a very easy year at all. So when McDonald's speaks, we have to listen, right? These are very important consumer insights. That being said, McDonald's was up about 2% on the day. Earnings, not the best earning from McDonald's, 3.21% to the downside in terms of EPS on a miss and a slight miss on revenue. So why is the stock up 2%? Well, kind of like e.l.f. Beauty. They're the best performing company right now in a very difficult consumer landscape. So they're being rewarded for that. But not only that, there was some better things in terms of guidance and whatnot. Revenue was up 3% year over year. Not the craziest, but still, right? Comparable sales in terms of same store sales, guys, very strong numbers right here. Take a look, 3.6%. I'll remind you that McDonald's, for the first time in a very long time, in 2024 and even early 2025, Q1, they had negative or flat year-over-year comparable sales. So for them to see a return to growth, it's very important. It means that their promotions and marketing campaigns have really been paying off well. US comparable store sales, 2.4% year-over-year. Look at the increase year-over-year. 700%, guys, right? As I said, you might consider these to be easy comps last year because they were negative, but, right? What about names like Chipotle and things of that nature, right? They also have tried to do promotion and marketing campaigns. They haven't been working. McDonald's arguably is the value king. They've been doing this stuff, guys, for decades and decades and decades. They know how to navigate these tough consumer landscapes, and they have been implementing changes with their menus that, as I said, have been working really well for them. Now, in terms of the estimates, right, comparable sales beat 3.6 versus 3.59, US 2.4 versus 2.14. We went over these numbers before, but I just want to show you they did beat the estimates, which is why McDonald's is up higher. Comparable sales is the most important thing when you're talking about restaurant brands or even, you know, places like Costco, places like Walmart as well, right? International operated markets, 4.3% versus 3.8 expected, and international development licensed, 4.7. They missed the mark here, but 4.7 is still very strong, guys. You're talking about other businesses, international businesses like Domino's, like Starbucks, and like all those guys are not performing as well as McDonald's, right? Operating income, still McDonald's finds a way, man, of putting up ridiculous margins. They put up, again, 32.2% net margins. Now, of course, you guys know McDonald's business model. They have big economies of scale. Their supply chain is so well optimized, it's not even funny. And of course, their franchise model allows them to be somewhat of a real estate company as well, to where it's a toll booth company. They just collect fees, right? A lot of the times. Moving on further here, in terms of further numbers, right? Or rather, we can move right into the article, but here we go. We increased global system-wide sales by 6% and grew comparable sales across all segments, delivering everyday value, menu innovation, and compelling marketing. Special focus on compelling marketing. McDonald's really knows how to bring those promotions out when they need it the most. Let's move into their earnings here. McDonald's sales rise, but CEO expects low-income diners to spend less into next year. This is big. This is really big. If McDonald's is telling you this thing, you have to kind of take it to the bank, right? The K-shaped economy is very real right now, meaning high-income consumers are doing well and low-income consumers are really not. The CEO said in a statement that the third quarter results are a testament to our ability to deliver sustainable growth even in a challenging environment. As I keep saying, McDonald's is the value king. For more than a year, McDonald's, long considered a bellwether for the financial health of consumers, has been sounding the alarm about a pullback in restaurant spending, particularly from low-income diners. That downturn continued during the third quarter. We continued to see a bifurcated consumer base, with traffic from lower-income consumers declining nearly double digits. I'll say that again. Traffic from lower-income consumers declining nearly double digits in the third quarter. That's very big, guys. But Chipotle was complaining about, Cavo was complaining about, and so many other businesses too. Cheesecake Factory, et cetera, Texas Roadhouse saying it's a tough environment. A trend that's persisted for nearly 2 years. In contrast, QSR traffic, QSR is quick service restaurants, QSR traffic growth among higher income consumers remains strong, increasing nearly double digits in the quarter. If there isn't a better picture of the K-shaped economy than what McDonald's just said, I don't know what we could possibly look at. Yeah, I mean, the banks told us this, the credit card companies told us this, the travel companies told us this, but you see it clearly in McDonald's. Low-income consumers declining double digits. High-income consumers increasing double digits. So they kind of offset each other, right? He added that McDonald's is projecting that the pressure on consumers' financial health will continue into 2026. Moving on further, the company credited growth in average check, suggesting that diners are paying more for their meals despite the ongoing value wars between fast food chains. It's very funny. Yes, McDonald's is employing a lot of promotions, but the regular menu items, they tick them up ever so slightly. So McDonald's doesn't have the most pricing power in the world, but they have some. In an appeal to budget-conscious consumers, McDonald's brought back its snack wraps for the first time in 9 years and priced them at $2.99. The CFO said that it was one of the most popular chicken launches in recent history in the US, with nearly 1 in 5 customers purchasing a snack wrap in the first 4 weeks. And in September, the chain reintroduced extra value meals, which it last promoted before the COVID-19 pandemic. Executives said that McDonald's value offerings have helped the chain gain market share with high-income diners. I think that sometimes there's this idea that value only matters to low-income consumers. But value matters to everybody. Whether you're upper income, middle income, lower income, feeling like you're getting good value for your dollar is important, which is why I say, man, they're the kings of the value chain. Outside of the US, McDonald's saw even stronger same-store sales growth. Its international operated markets division, which includes Australia and Canada, some of the more mature markets for McDonald's, reported a 4.3% increase in same-store sales. The value platforms we've had in place for several quarters in our international operated markets division are resonating with our consumers and continuing to improve value and affordability scores. In their international developmental licensed markets, where they're growing faster, same-store sales grew 4.7%, lifted by demand in Japan. Looking ahead in the fourth quarter, the company is projecting stronger U.S. same-store sales growth, fueled by the return of McDonald's monopoly and the extra value meals. What you're seeing right now, in other words, guys, of course, we can talk about the K-shaped economy, right? But all those Chipotle consumers, all those health conscious consumers that used to say, well, we're moving away from fast food. We're going to go to fast casual and healthier burrito bowls and healthier kava dishes and things of that nature. Yeah. Apparently, a lot of that demographic, now there's no statistics around this, but I assume they're kind of heading back to McDonald's and getting those value meals when they want to eat out, right? There's no statistics around this, but if McDonald's is doing so well, not only in the US, but also internationally, it must be because people are substituting some of their restaurant meals out elsewhere back towards McDonald's because they actually see value in this brand, whereas they don't maybe see value in other brands. I'm not saying that McDonald's has healthy food. Of course it doesn't, right? But when you're talking about going out for something quick, right? Maybe you don't want to spend $15, $20, even if it's a healthier option. If you're budget constrained, well, maybe you take the unhealthier option and you go for some of those $2.99 chicken snack wraps, right? So that being said, McDonald's, strong earnings and a very tough division segment. Moving on further, is McDonald's a good buy at current levels? Well, in terms of their numbers, they will be growing revenue at 5% per year. Not the craziest revenue growth, guys, but they are so experienced at growing through all markets. EPS will be growing 7.5% per year, always finding a way to drive margins to the bottom lines, even in tough environments right now. At 305, I mean, we can't really use the PEG ratio because their EPS is too slow, right? But what you can use is the best metric for McDonald's is in terms of historical averages, because McDonald's has been doing this, guys, since the 1970s, roughly. Like, look how far this chart goes back, right? They're a long-standing company, so we can use historical averages and derive whether the company is expensive or cheap in relation to those averages. Right now, the company is just average. It's a 23 forward price to earnings, which is roughly in line with the historical averages of the business. Is it cheap? No. Is it expensive? No. So is McDonald's a good buy? Well, let me be honest with you guys. It's not for everybody, right? It's a stock that pays a 2.5% dividend. It's a stock that's very resilient with consumers, and that across many, many, many different macroeconomic backdrops, right? It's not for everybody. It's not the sexiest company. It won't have, growth spurts as fast as your Kava stock share price when it was like this, as fast as your Chipotle when they're expanding their business, expanding sales, and it's when it's really trendy, right? But it is a very defensive company overall, and it does hold its position in that type of investor's portfolio. So McDonald's is, in my opinion, a very solid investment because you know what you're getting. You're getting a battle-tested company that has been through tough times before, that has tricks up its sleeve in terms of promotions, marketing that can allow it to keep driving margins, keep driving same-store sales, and keep the company afloat. It's a worldwide recognized brand that has made its way into almost every country, right? That quick service restaurant in which quick service restaurants work, you can find them everywhere, right? So it's a tried and tested company. It doesn't have the sexiest growth. Some years it outperforms the S&P, some years it underperforms, but at least you know what you're getting. McDonald's is a company. Let's say I was looking for something dividends, but still having decent growth. McDonald's would probably be front and center, top of my list for that style of company. And that is everything that I had for you guys for today's earnings. Hopefully you guys enjoyed another long video in terms of earnings presentations. We're already an hour deep. So let's get into our indexes. Then we'll get into our big tech names. And hopefully we'll have some time at the end of the video for our biggest gainers and losers of the day. So in terms of the SPY, guys, we are still underway into daily consolidation. The higher lows, I'll remind you, are down here at 664. You can see in the futures market right now, we are a little bit red, so we will see how we open tomorrow. But definitely the breadth concerns are front and center, or should be, on especially you guys that are trading these markets right now. It's just not a very easy market landscape to trade, at least not to the effect that it was back in September and October. That being said, we are into support right now, 673 down to about 669. There's a little bit more of a gap to be filled here on the S&P at about 672. So we will see, are the bulls able to defend this area and just continue on, or will we need a little bit more of weekly healthy consolidation? The weekly bulls are still in full control of this gorgeous weekly uptrend right now. And the worst case scenario, we might come back down to the 12 EMA, which is sitting right around 662. So keep that in mind, guys. Watch your levels, watch the weekly retracement sizes as well on the S&P, and definitely watch the market breadth. Moving into the QQQs, look at this very nice daily uptrend right now. we are still in the form of daily consolidation overall. So the daily higher lows are down here, 599, 600, let's call it. You might think it's a daily downtrend, but it's actually not. It's just because futures action is kind of awkward. If you take a look at the futures chart, you can clearly see there's just one move down, right? So keep that in mind on the Qs. We are coming into support soon, 612 down to about 607. Keep that in mind as well. And in the event that we unwind this entire move and move into the daily downtrend, you should understand that it's looking like weekly consolidation, right? So that being said, the weekly higher lows are down here, 591. We have not lost this weekly uptrend since the month of April. So pay very close attention to 590, which is your weekly higher lows. Might come back down and test the 12 EMA if weekly consolidation lasts into next week as well. So please keep that in mind. Moving on to financials right now. Financials participated a little bit today, but I wouldn't say it was a crazy rally, right? Still very choppy price action, trapped between two levels. Overhead resistance, 53.30 down to 52.89. And the big area of support that we should maybe be playing off of on financials, right, remains 52 down about $50. It's a huge level, guys. Right now, essentially what you're seeing is very healthy monthly consolidation, right? Nice rally 4, 5, 6 months after tariffs. Red month of October for financials, and now month number 2 of consolidation into support. We will be looking for these bulls to defend this area and the 12 EMA as well. Moving on to healthcare right now. Healthcare up a little bit today, challenging resistance again, but I'll be honest with you guys, we're going to need more than Eli Lilly. This has been the problem with healthcare. Over the past few weeks, it's only been Eli Lilly. Let me just move myself to the side here and you'll see what I mean, right? Look, 1 week relative performance. It's literally only Eli Lilly. Shout out to AMZN and a few other companies trying their best. But you know, healthcare insurance, UNH and that group, still down. Medical devices, okay, but a little bit mixed. Eli Lilly has been carrying this sector on its shoulders, man. You need a bit more broad performance than that. But daily uptrend is looking okay. The higher lows are set right now at 142.80. As we challenge this whole 148 to 145 level, we'll see if the bulls can get it done and try to break through. It looks good on the weekly, right? Doesn't look too bad on the weekly, but we will see, right? It's not done until it's done. You're going to be looking for them to crack above. Line in the sand on the weekly is down here, 141. You don't want to lose that. If you lose that, they lose the weekly uptrend, and unfortunately, you'll be heading into a bit of monthly consolidation, maybe for a bit of a downswing before resetting and then trying to move into it into 2026. The monthly MACD looks good though, but you guys know it best, right? Healthcare moves very slow. Moving on to semiconductors right now. Semiconductors, bit of an awkward day. It was up 2%, right? But they didn't really do too much. It's kind of an inside candle with yesterday's declines. That being said, we are still in the context of daily consolidation right now, looking for a new higher low, anything above 332.50, looking for that higher low, possibly for further trend expansion, right? You can take a look right here. That's a big support level, 346. So we'll see what happens when they pull into this area right there. In terms of the weekly, guys, we're still very extended, yeah? Weekly overbought conditions. So in the event that the market continues to be a little bit soft, you would not be surprised to see a bit more weekly consolidation by the semiconductor index right there, and probably coming down to the 12 EMA, which is about 330. It wouldn't look too awkward, right? Pulling into the 12 after weekly overbought conditions. At least I wouldn't think so. It did that all the way back here. Consolidate sideways with a slight down bias. Maybe the same thing, right? Maybe a bit more. I'm not calling for this, right? But maybe just sideways with a little downward bias until the 12 EMA catches up in a few weeks. I would not be surprised if that is the case, because a lot of semiconductor names, guys, have ran excessively hot over the past 2 months with good reason because of the AI build out, of course, yeah, but nothing moves up in a straight line. Moving on to the IWM Russell right now. So the Russell up 1.44%, but still kind of the same as semiconductors, right? They erased yesterday's losses, but they didn't really do too much more. The line in the sand is still here. We did not crack it. 241. The bulls are desperately trying to hold on to this daily uptrend. If you unwind, either just straight flush or you get the lower high into lower low, daily downtrend, and then I'll remind you what we're looking out for. You are looking quite simply for weekly consolidation, but maybe even monthly consolidation. And if that does happen, if the SPY and the Qs drop a little bit more and we move into a bit of choppiness over the next week or two, well, then we might just be expecting a good old pullback into 230 down to about 225. It would be nice. 2020, 2021 highs, resistance highs as well. 12 EMA sitting right there. A big pullback like this would be very healthy, in my opinion, for the Russell before we might get some appreciation into 2026. That's everything for your overall sector rundown. Tomorrow, or rather on the Friday section, we'll do more. We'll do defensives. We'll do all that good stuff. Moving on to, I guess we could talk about the VIX a little bit today, right? So the VIX coming down today, of course, because of the positive jobs number. But we'll see, right? If you get big red days in the market, of course, the VIX is going to move higher. But you can clearly see, right? We're not in a soft and muted environment. There is something going on in terms of market internals right now where people don't fully trust these levels on the SPY or QQQ, or people just don't want to fully commit. As a result, the volatility has been notably higher in the last 1 week of trade. I'll remind you, when volatility comes close to 20 or above 20, it is a very nice environment to be selling options, right? Just benefiting from those volatility increases overall. So play the VIX accordingly. On to yields right now. Well, yields actually moving a lot higher on the Wednesday session, and that is quite simply because we had a decent jobs report, and we know that Jerome Powell told us last week, listen, the December rate cut is not a foregone conclusion, which were his words. And as a result, the rate cut probabilities have been dropping, right? I'll remind you, prior to the meeting, we were like at 90% odds of getting a rate cut. Now, yesterday, we were at 65, or 1 day ago, we were at 68%. And now after a favorable jobs report, it once again pushes us into uncertainty territory of whether or not the Fed will be giving us an extra interest rate cut in the month of December. If jobs are still okay and inflation isn't runaway inflation, maybe they don't need to cut rates as fast as some people might want them to cut rates, which is why your 10 and 20-year yields were up today, and another reason why your bonds are kind of just pulling back and pulling back and pulling back. This bond trade has been extremely challenging. I get it. It's a very slow-moving sector. You keep getting conflicting information between the Fed and what the yields are telling you, X, Y, Z, right? I do think it is still a nice trade for some expansion, but as I keep saying, guys, it's going to be a very slow trade as we move through the various data points that the Fed is looking at. Keep that in mind. On to gold right now. So gold still remains a little bit soft. They had a decent Wednesday session, up 1.22, but not doing anything, right? We're kind of inside trading here. No breaks of the lows, no breaks of the highs. If we break these highs, 4,041, new daily uptrend. And you can say that potentially the weekly higher lows are established. If we do get the breakout here, well, then we get a stop loss area. The stops go below there, right? And then you're looking for weekly expansion back to the highs. That's how you would structure a similar type of breakout trade, right? Now, if we move to the downside, right, then daily downtrend simply continues at that point, and then you can structure a different type of trade. You break out down here, stop loss goes down below there, and then you're kind of targeting the round number levels for further pullbacks, 3,700, 3,600, etc., as you move further into this weekly consolidation phase for gold. So very tough to position on gold right now. Not enough price action either way. I'm going to need to see a break in either direction to properly position for some short duration swing trades. But the weekly bulls are still in control. A lot of space to work with here for some further pullbacks, and the monthly especially. The bulls are still in control, but as we've noticed, right, we're very overbought, man, on gold's timeframes. Last monthly candle was not too good. So if we continue pulling back, I don't think anybody would be surprised after such a massive rally. The environment, right? This is what I mean when I say, guys, there's not many easy trades in the market right now. Gold trades here were easy, very easy, right? The short-term time frame showed it, the momentum showed it. Now gold is not an easy trade anymore. We've lost a lot of the easy trades in the last 2 weeks. Moving on to Bitcoin right now. Bitcoin on the day, up a little bit from yesterday's disaster, the liquidation break below 100,000. We had a nice little day of recovery on the Wednesday session, 2.37% to the upside, but still, the bulls are still a little bit weak, right? Daily downtrend for sure, weekly downtrend in motion as well, but the bulls are defending this infamous area, 107 down to about 100,000, flat prior resistance, chop zone, and support as well. The best time frame, the clearest time frame in my opinion, guys, remains the monthly, right? We are in still a nice monthly uptrend, but we're just in monthly consolidation and have been arguably for the past 4 or 5 months. We have now touched the 12, which is good, which is why I've said, right? This is a nice accumulation zone, but save some money in the event they go for a larger retracement size from this entire move. Yeah, in terms of the fibs right there, that would be the good old 50 to 618 retracement size. And that is the area that I would be potentially looking for a DCA, 93 down about 88,000. Now, we can't say that it can't go down there. We just literally had an example on Ethereum, right? To where the bulls were defending this area. Ethereum right now, right? Daily downtrend, everybody knows that. Weekly downtrend, it's been a weekly downtrend for, a couple months at this point in time. The bulls were trying to defend the backtest area, the big backtest area. But I kept saying on the channel, guys, be careful because it's a weekly downtrend. Crypto is soft right now, and even though the monthly looks good, you might get a full retracement down to where? down to the 50 to 618 fib. We literally cracked the 50 fib yesterday into the second area of support, which is 33 down to 29. So hopefully some of you guys are able to pop off some DCAs right there. If you were accumulating positions there, I still do believe that this is a nice area to accumulate. The bulls still have a lot of space to work with here. And if you believe in the fundamental thesis of Ethereum expansion in terms of more use cases for integration into traditional finance, potentially real world assets down the line as well, then it does make sense to accumulate at these lower levels. Hopefully you guys appreciated that analysis right there. Now, let's move on to some more big tech names, shall we? So moving first into Apple, I'll try to get through these big tech names a little bit quickly, just so we can get to the biggest gainers and losers, right? So Apple still maintaining the daily uptrend, looking pretty good right now. Yeah, not too bad, but we also know that they're a little bit overbought on the weekly, and the monthly time frame is very extended from the 12 EMA as well. That being said, the weekly bulls are still in control of this chart, looking very good. So I'll remind you, in the event that Apple falters and has to go for a deeper retracement size or a loss of the daily uptrend into weekly consolidation, you got a lot of space to work with. Anything above 245, just looking for a new higher low, possibly coming back down and touching the 12 EMA, which is something that Apple likes to do a lot. Apple had earnings just last week and we covered them on the channel. Make sure to go check that out if you haven't so far. Very nice guidance for Q4. So I am expecting a good Q4 from Apple, but we know that the price action in the markets recently has been very choppy. So I'm not doing any swing trade longs up here. I just don't think there's the best risk to reward. And I'm also not adding any Apple shares up here because the valuation is a little bit stretched, but I'm not selling any Apple shares either. Moving on to AMD. AMD up 2.5%. They reversed the earnings declines that we saw yesterday in the after hours. The daily uptrend is still in favor to the bulls right now, but you're noticing, right? A little bit soft. Now, we covered their earnings on the channel yesterday. If you didn't have time to see those, definitely go check those out. We did say that AMD right here around 240 where it was a pretty decent buy. It's trading at a 1.1 peg and a 9.55 forward price to sales. Very good, but it's also going to be a long-term thesis. I would be lying if I told you guys that we can't pull back more, go into a daily downtrend, and go into a little bit of a weekly retracement overall. I think the stock would benefit from that because we're in overbought conditions on the weekly. So this is another example of a stock whereby if you have a long-term thesis and you're just looking to add shares to benefit from the company's fundamental execution over the next 1, 2, 3 years, then it makes sense to buy here and DCA and just add to some positions that you may have bought down there because the valuation makes sense. But if we are swing trading in a very choppy market, right, on technicals that are very extended, well, maybe there isn't the best risk to reward. So hopefully that makes sense. Moving on to Amazon right now. Amazon up 0.35% overall, but not a very strong day, right? They had very strong earnings, came up, and now pulling back a little bit with the overall markets being very choppy. Daily uptrend, though, is clear as day. The higher lows are all the way down there, 223. So we will see. If Amazon goes for the full retracement, I will be a big fan of playing this one, right? Previous resistance for a very long time. Now should be a good old breakout or retest trade. So I will be looking to add some shares down there as the valuation at 230 should be pretty good. At 250, it's already decent. So 230, 10% lower, we would be looking pretty good. Selling some put options, adding to some shares right there could be a nice technical setup and fundamental setup at the same time. Moving on to Google right now. Google up 2.41% today. And this chart, man, is kind of maxed out, right? We know we're in daily overbought conditions. We know Google is also in weekly overbought conditions. Usually it doesn't stay at 80 RSI forever. And Google's just been performing really well recently. I'm not going to lie, yeah? Daily uptrend is nice, but still in daily consolidation right now. So we will see, is Google able to keep up these gains and push 300, or will they be brought down with the rest of the market into a healthy consolidation phase? If they are brought down for any which reason and we lose this daily uptrend, you're going into a bit of weekly consolidation, which would be very healthy for the stock, right? Beautiful weekly uptrend. The higher lows are way down here at 236. If you get a pullback down into here, maybe in like the 250 range, I would be a fan of adding some Google shares. The valuation makes sense up here in the 280s for some long-term shares, 5-10 years out. If you're looking to buy, it makes sense to DCA a little bit up here. On a pullback, though, that's when I start applying maybe some short puts and maybe some swing trade strategies to get a better technical entry. Because right now, the risk-reward profile is not the best for short-term swing trades. It's a very greedy long up here for short duration swing trades. Moving on to Meta. Meta continues to kind of be very soft, right? After their earnings down tremendously. I will remind you, from the all-time highs, Meta is still down 20%, which does put the individual stock in a bear market. So big momentum to the downside, big oversold conditions on the RSI. The only time they've been this low was during the tariff sell-off and in the depths of 2022. So is Meta a decent buy here into a small area of support? Yeah, but don't count on this support area very much. It's not the largest support area, so please keep that in mind. The momentum is very much in the favor of the bears right now, and if you go for the full retracement into a larger area of support, that would be 600 down to 560. The weekly is clearly in a weekly downtrend, and we are clearly in a monthly consolidation phase for the stock. We covered their earnings last week when they had their earnings, so definitely go check it out if you haven't seen it. The problem with this company was the expense profile was raised and the CapEx profile was raised, and Wall Street isn't convinced that those extra expenses and extra CapEx are actually delivering AI returns, at least in the short term for the company. That's why it's been down. However, Meta around 630 is a decent buy for the long-term portfolio, in my opinion, trading at a very low 21 forward price to earnings ratio and a 1.63 peg. These are some of the lower valuations that you would have been able to come by on Meta in a very long time. So I am a fan of buying here. Swing trading is tough, guys. It's very tough because you don't have a confirmed daily uptrend. So you cannot say that this is the actual bottom until they give you confirmation that it's the bottom and you can get a tradable stop loss level. If you're just buying here, putting a stop loss below there, that's just wishful thinking without confirmation. This stock is either a buy for long-term shares or leaps, 2027 leaps in the money, 70 delta leaps type of trade. They're expensive, but it's a share replacement strategy. You're using the declines right now into oversold conditions to build a position that you will carry into next year and into early 2027 as well. Moving on to Microsoft right now. Microsoft furthering its declines, 1.39%. Oof, challenging the daily lows, guys, right? They had a nice push after earnings. They gave it all back from that top. It looks exactly like last quarter, right? From the top, down 8.3% overall. So no, I'm not going to swing trade Microsoft from here. It's a little bit soft in terms of momentum. Yeah, we're also in jeopardy of losing the weekly levels. Now pay attention if that happens. If they lose the weekly, monthly consolidation is just going to continue at that point, and we might be heading down here to the 12 EMA 475. Microsoft often comes back after big rallies and back tests its 12 EMA or very close. I will be patiently waiting for that to happen. Is Microsoft a decent buy here at the lower 500s? It's not a bad buy, trading at a 33 forward price to earnings and a 1.9 peg. It's not very cheap, but it's also not ridiculously expensive. So if it does come down there to 475, the valuation will be more manageable, and that is the location that'll be adding a few more shares. I've been patiently waiting for that level since like the month of June or July when they popped off here. If they give me it, I will be buying, just as I am doing the same thing on this next company, Netflix. So Netflix coming down into its own monthly 12 EMA. Daily price action, still very choppy, right? It is a daily downtrend right now. The bulls are looking to play a bit of defense. They're trying their best, right? But they're kind of swimming upstream against all these bears right now. Over above us, we have a big resistance area, 1150 down 1100. I will remind you, the stock is going to split, right? Come the week of November 14th. That should be very interesting. We should be getting a lot of flow into the options market. In terms of the weekly, we are still in the context of a weekly downtrend. And until that's no longer the case, we are in the context of monthly consolidation as well, into where? Into the infamous 12 EMA. So I am a buyer of long-term Netflix shares into the $1,100, $1,000 pocket down there. The valuation here at $1,100 is not too bad. 34 forward price to earnings and a 1.7 peg. So a decent discount, guys, from the highs that we saw earlier this year. And I am buying some shares for my own long-term portfolio down there. Moving on to NVIDIA. NVIDIA had a wild swing today, guys. They initially were down 2% on the day. I mean, in terms of how they open, they went up 2% today, and then they went down and ended down almost 2%. A wild swing for NVIDIA. And look, what I was saying in the introduction of the video, right? All of that in the last hour of trade. Very unfortunate for this company, but as of right now, we are in the context of a daily downtrend, which means weekly consolidation has started, possibly into where? Well, into the most logical level that we have, which is this area that we just broke out of, 185 down to 178. I'll be waiting for this one. I will be looking to maybe explore selling some short puts down there and maybe even acquiring some shares for the long term, because now we have the forward guidance, right? 500 billion through the next 6 quarters overall, which, where they were at 206 when they announced that, gives them a peg ratio of between 1.26 to 1.43, depending on how bullish you want to be with your EPS growth expectations. Keep in mind, we have to estimate right now because Jensen is going to give us the possible guidance formally when they have their earnings the week of the 17th of November. So that's when we'll be able to establish a more concrete EPS growth rate on average. But as of right now, the range does support some possible DCA buys down here into the 185 section, and maybe even a nice swing trade location, as well as some possible short put plays. So that's one that I'm patiently waiting for. Moving on to Tesla right now. Tesla with a good day, 4% to the upside. Not too bad at all. They're desperately trying to set up for the big breakout towards 500. Now, if the SPY and QQQs recover, then you can possibly get this breakout to 500. If we continue to get choppy markets and a wind down of positioning here, then it's not going to go for it. It's just going to get stuck here, right? But at a first glance, it does appear to be a bull flag breakout that wants to go for the next level. But as I said, guys, that breakout is going to be beholden on the overall market performance, in my opinion. So if that doesn't happen and the SPY and QQQ die, what's going to happen is we're coming right back down there to the lower end of this range, 415, and maybe even lower. If it really unwinds big, you might come back down here and test the 405 to 385, which would be the next area for some swing trade longs as the monthly 12 EMA catches up to the price. Moving on further beyond Tesla, Palantir, a down day again today, 1.5%. Palantir was down like 3.5%, 4% today, but they did recover a little bit intraday. Daily uptrend is still maintained. We got a very nice back test here. We broke out from a big level. The level is 185 to 171, and now we are back testing it. There is a swing trade opportunity for Palantir, guys, but it's kind of like Tesla, right? If the overall markets just keep declining, Palantir is not going to be able to go through the big breakout, yeah? So this trade idea, it has a decent risk to reward profile, but you got to understand we're not really in a trending market right now, okay? So the trade setup is as follows. The long entry points are here. The invalidation stop loss is down there. And what you're going for is a breakout from the highs, possibly to the psychological 220 area right there, which would give it a favorable risk to reward profile of almost 2-to-1, right? Or actually, it is 2-to-1. However, keep in mind though, guys, yeah, it's a very choppy market right now. And if your SPY and QQQ keep unwinding or keep being very choppy, then we might just head either into this support and chop around for a while, or maybe even we come below it and then we just ruin the weekly uptrend breakout overall. So I'm not looking actively to do anything more than maybe a very small swing trade with a stop loss on Palantir. And we did cover their earnings in terms of the fundamentals Monday after the close. So make sure you go back and watch my video on Palantir's earnings for more thoughts on the business. Moving on to SOFI right now. SOFI just consolidating again, 2.38% to the upside. And this is kind of like Palantir as well, right? You can derive a bit of a swing trade thesis here. It's a daily uptrend breakout from a big resistance level, which is now clearly support in the last 4 days, yeah? You can go for a possible swing trade here. The stop loss would possibly go below the 28 psychological below support down there because you're going for the breakout, yeah? If it doesn't give it to you and we flush these lows and you lose the daily uptrend, well, the trade is invalidated, and then you're going to be looking for a bit sharper or a bit steeper weekly declines, right? So there is a swing trade thesis here from here with a stop below 28 and possibly some expansion into psychological 35. But like we said for Palantir and Tesla, right? These swing trades are live, but you have to battle against the choppiness of the indexes. So that's why I say it's not as clear of a market as it was in September and October, which is why even though these swing trades look great in isolation in their own little bubble, well, if the overall market sentiment is still soft, well, they may just not play out and we may just get more consolidation, which would bring you maybe down to the weekly 12 EMA. Go for a little bit more weekly consolidation for this stock. Long-term portfolios, though, at the $30 range, not a terrible buy, a 1.22 peg. Moving on to Uber, which had its earnings just yesterday, right? They had a nice little pop after those 10% declines. Sadly, down 2% again. So unfortunately, the daily uptrend is now unwound and we're kind of just shopping around doing a whole lot of nothing, which is arguably what we have been doing for a very long time. And we've been noticing this, right? Coming into Uber earnings. Look at these legs of expansion. Big leg, small retracement. Decent leg, bigger retracement. Small leg, big retracement. And now one final leg and then full retracement. So that is telling you that the price is losing momentum. It's losing steam overall, yeah? So if this market remains soft, which I wouldn't be surprised if it does, right? We might expect a crack down below support, 93 down to 90 bucks, and you may expect a weekly downtrend into a bit of monthly consolidation, which would not be the worst thing for Uber. If that does happen, I was very clear on their earnings yesterday. They posted really good monthly active users, really good month bookings, really good trips, and mobility and delivery segments outperformed. So if a business's fundamentals are getting good, but the stock price is going down, well, that's what translates to a buy, right? If I can find this one in the low 80s as they kind of come back down here and backtest the former area of resistance, which will be new support, mid 80s is where I'm looking for possible, short puts and possible additions to long-term shares as well. And now lastly, moving into TSM releasing some amazing price increase news the other day. 2 days ago, they said they'd be increasing prices 5 to 10% every year for the next 4 years. This company has insane pricing power. At $295, it has a decent valuation as well, under a 30 price earnings and a 1.7 peg. It's not cheap, but it's also not expensive. But you know what the problem is even with those nice releases, look, it's been very choppy. They had insane earnings. They've done nothing since earnings. It's going to show you guys, like, it's not as easy as the September market. When we were looking for the back test of the 12 EMA, right? And we had good price action right there. We were not that overbought. We pulled back a little bit into the moving averages. And you could drive a swing trade thesis for the company because back there it was trading at a low 20s multiple. Now we've increased in terms of fundamentals. We're well off the 12 EMA. Momentum was very strong. We're weekly overbought, so it's tough. That's why the price action is choppy. So we might just be getting a little bit of pullbacks here, maybe into the lower end of this region, 280, into the 12 EMA as well, 275. So keep that in mind. TSM is a fantastic company, but it did run extremely hot, guys. You're talking like from this consolidation range to those tops, that's a 37% move in like a month and a half. It's like, how much more do you want, right? Nothing moves up entirely in a straight line all the time. And the monthly as well is somewhat overbought. See here, you can make a thesis that we're getting closer and closer to consolidate to the 12, backtest it. It was chopping around for multiple weeks, call it 2 months at a time. Building. The guidance was strong. The valuation was good. That is when your fundamentals and your technicals line up for a beautiful swing trade, right? Now, you don't have those two things lining up, so keep that in mind. That is everything I had for you guys for the overall market rundown and for your earnings. I'll spend a few minutes on these biggest gainers and losers, but we're now half in the video, guys, so I cannot spend the usual 10-15 minutes that we do on these. But let's look at a few of them. So I'll cover a few of these names, not all, but just a very few of these names. Since we don't have that much time, just some names that could be interesting. Number one is going to be Axon. So Axon came down 20% after their earnings yesterday. Potentially, I'll be able to cover it on the Friday video because I want to bring this one to you guys. I know a lot of you guys are interested in this one. They missed on EPS. The problem with this company, guys, is that it really was priced to perfection. You're talking about a company right now that trades roughly around between a 2.5 and a 3 peg, depending if you use 2025 end of year estimates or 2026. That's very high. It's priced to perfection. It doesn't have the most phenomenal net margins either. You can see the margins are kind of all over the place, right? Sometimes teens as they kind of try to scale into their business. The most recent quarter was very soft as they missed on that EPS estimate. The company is growing really well. I got to give it to them. EPS up and to the right, revenue up and to the right, and the ecosystem. The ecosystem is very strong, but at $640, the stock is still priced to perfection. This one is good for a long-term investor, but maybe a bit difficult for establishing some swing trade levels because even on the higher time frames, guys, like we're a bit extended. It's pulled back into the 12. I need to wait and see, can they establish some price action structure and build a bit of a shelf of support into these guys? Because the price action on this stock, guys, is so choppy, and it's also not the cheapest one to play for options. Long-term shares, it's okay to nibble. If I had to build a position on this, it would be from here back down to the earnings lows of around 500. Then it would make sense if you're looking for like a 3, 5, 7, 8, 10-year investment horizon because the ecosystem of the business is really strong. But the one thing to look out for, man, is this right here, the stock-based compensation. Their shares outstanding. They just do way too much. Look at this increase in stock-based comp, man, especially over the last few years. It's really, really bad. So that's one red flag around the business, but can't take away from them great products and a great ecosystem as well that people that use their products, police forces, tax forces, etc., they really enjoy it. Moving on to Arista Networks. Arista Networks, you might remember this one as a darling of the data center trade. I was a big proponent of Arista Networks down here when it was trading under $100. This one had earnings literally yesterday. Maybe we can cover it on the channel on Friday, potentially. And look, great earnings. And honestly, their guidance was really good as well. But this is another company that even though they posted great earnings, the stock still went down 8.5%. And you could pick apart the earnings as much as you want. But honestly, you know, if they posted these earnings when they were down here, the stock would have been up probably 7-8%. But there's so many companies, guys, over the last 4, 5, 6 months, they ran too hot. The expectations ran ahead of the price a little bit. And now you're just seeing normalization across several different names in several different sectors. So keep that in mind. Arista Networks will become a buy for me again. If we go for a more full retracement size here, around the $130, $120 range, because even at $130, guys, I mean, let's be honest, Arista Networks was not cheap, which is why I loved it so much under 100. I need to see at least a technical entry if I'm going to try to play this one, because the valuation, at least the time we did it in August, right, it was quite high. And even up here, it is still quite high if we take 2026 estimates. Figma, and then one last one. Figma, we'll talk about a little bit. They had earnings today, maybe as well. We can cover it on the channel over the next few days. We'll see what happens. They kind of went up, they went down after earnings type of thing. And now they're just where they were for a majority of the daily trading session right now at $46. So last time we did the analysis on Figma was back in September when they had their earnings. The numbers haven't really changed since. We kind of derived a bit of a straight line price to sales model saying, if you agree with a whole bunch of assumptions that they can get up to 30% margins and you assume high price to earnings ratio multiples, then maybe by 2029, the share price could be worth $145 to $150. But keep in mind, guys, you got to assume so many things. You assume that revenue will compound that will compound at a growth rate annually of 20 to 25%, not 35%, and 40 to 45 price to earnings as well. That's on a slower end. If this is the bear case scenario. This is the base case scenario, right? That people are modeling. This is the bear case scenario. If competition is high and they have slower revenue and multiples, then it only becomes a $90 to $100 stock by 2029. So essentially, if we're looking at market cap right now, it's a $22 billion company. I'll remind you, Adobe tried to pay just north of $20 billion for this business a few years ago. If you ask me where I wouldn't mind buying Figma, where the risk reward makes a lot of sense, honestly, below 40. And I've held that same thought process this entire time that it's sold off. If it comes below 40, you get me interested. I know we're almost there, but maybe if we're looking to play some short puts, not that bad of an idea, but momentum is clearly down. The business is trying their best, right? But let's be honest. I mean, they're not making a tremendous amount of revenue just yet, right? That will come in future years, of course. So at only $1 billion per year run rate between 1 and 1.5, stocks trading for $20 billion, it's still expensive here at 2026. If you're buying it, you're really buying it for the longer duration thesis overall. So those are just 3 companies that I wanted to cover that have had earnings recently. I mean, the rest of everything was only down like 1%, so there's not too much to say. If you take a look at the names that were on the highs today, especially names like Rivian, I mean, Rivian is still losing money per car sold, right? But we talked about it down here to where it could have been interpreted as a decent swing trade out of the support level. I'm not investing in the company long-term, but you guys do you. In terms of upside, guys, I guess we'll have to see, but they did have an okay earnings release. The company still loses money on every single car they sell. There's some really nice models and some really nice designs that resonate well with consumers. But in terms of a stock investing in the business, it's really tough, man. There's still no clear path to profitability for the company, but it was a nice swing trade for some expansion potentially. If you take a look at other things, I mean, Iris Energy is the big winner of the data center niche, of course. They had that big deal the other day with Microsoft, and now they're just pushing up a little bit higher. This company has earnings tomorrow. The valuation right now, guys, at $76 is quite stretched if I had to admit, right? It's like trading on a 15 price to sales. So just be a little bit cautious around Iris Energy. Iris Energy is a hold or a tiny nibble at these prices, but I can't say it's an overwhelming YOLO buy. Other names in that same niche like NBIS have been pulling back recently. They also have earnings next week. So we'll see the price action here, not so clear. Iris Energy has been the biggest winner of that whole gang. APLD still remains a bit muted. Could be a possible re-entry opportunity in the mid-20s if we continue to falter. So just pay attention. I mean, even CoreWeave, right? These are the names that everybody talks about. CoreWeave is a buy for me, under 110 down to about $100 for a long-term trade as well, or maybe for some swing trades too. But even see that one's been very choppy. So Iris Energy is the clearest winner out of that whole trading segment recently. If we want to talk about the data center plays, Toast had some pretty good earnings, but I'll remind you, fintech is very difficult recently. But Toast is a good trade maybe for some short puts. Short puts down here in the mid 30s, don't mind it at all, but point of sale, and we know anything fintech and point of sale has been very challenging over the course of the past year and a half, 2 years. Toast continues to gain market share, but I wouldn't say their market share is just like crazy, but they're executing well. But is there a big growth story here that people are missing and this stock should be worth $65? No, but if they just keep executing on their business model, should they keep moving higher through the levels? Yes, because they're EPS positive and the revenue growth rate still is quite good. And I think that's kind of it, guys. I mean, we could talk about Micron. Micron is just ridiculous. Micron right now remains a hold for me. The times to buy were very clear, right? Down here, and you could argue even as they cracked the all-time highs as we did the valuation after last earnings. You remember when we did the valuation here? And I was saying, you know what? Micron is still cheap at 155. Still very cheap. At 237, the numbers don't look bad, but it's where we are in the technicals, right? Overbought conditions overall. So that's why I'm going to wait for a pullback on Micron, and I will be playing the pullbacks on Micron, but I like to have conditions where the fundamentals and the technicals line up a little bit. And right now we're missing the technical entry, right? But it is a hold. If we're holding any options into 2027, or if we're holding shares, it's not a sell for me. It is definitely a hold. And I think that's where we're kind of going to stop. If not, this video is going to be too long. So it's tough for me to do many more of these plays, guys. I covered so many of them after earnings. Like, you guys should already know my thoughts on Reddit after their earnings, especially with these valuations. Decent buys for the long term, and also decent little level to be selling some put options down there. So a lot of these we have covered after their earnings, and we will cover moving forward into the next week for the companies that haven't had their earnings. So I'm pretty sure you guys understand my thoughts on a lot of these businesses. But if you want, I'll try to cover more and more as we wind down earnings season. It's just that when I have 3-4 companies to do per night, we're going to stretch a little bit too much time if we dive too much into that list. So that's everything for today's video, guys. Another very long video as we wrap up this week. Next week for earnings, I believe, is a little bit less busy. These last 2 weeks have been extremely busy, so apologies for the length of the videos. I know some of you guys like it, but I know some of you guys would rather I do shorter. You'll see next week here, there's some interesting companies, but we may only be covering like 2 companies per day. So I'll have a lot more time to dive into the charts, give more thoughts on the market, et cetera, et cetera. But as of right now, we're kind of just smack down midway through earnings season. So hopefully you guys have enjoyed all the earnings presentations so far. That's all I got for you, man. So if you enjoyed today's video, consider dropping a like. Consider subscribing to the channel as well. If you're new, I would love to have you back. And last but not least, if you have any questions, please feel free, as always, to ask them down below in the comments section. Take care. See you guys tomorrow after the close. And I'll remind you, go watch that Saturday video if you have not watched it already. The first 30 minutes are very important to understand where you are in the market, what to look out for, both on the short term and what we have going for us in the long term, and deriving possible conclusions as to how you should be approaching this market in terms of your long-term investments and in terms of swing trades as well, right? So keep all that in mind. Definitely go watch that video if you haven't had the time. Arguably one of the best videos I've maybe made on this channel. That's it for me, guys. Take care. See you tomorrow. Peace.